and why the advisor role is so important is get someone in there looking at it for you that knows what they're looking at and can kind of evaluate the different fund options. So you're not just saying, well, yeah, like international seems good. I went to Italy a couple of years ago and I really like the pasta and I should invest in an international fund.
Hello and welcome to Unf Your Finances podcast with your host, Nick St. George. I'm your podcast producer, RJ Malik. Nick, how are you doing? And I see you have a guest.
Yeah, we're training wheels are off on the podcast. We're finally bringing out other people. I had to take Eric against his will here, but we got our first guest on the podcast. Pretty excited.
Did he sign a release form? So you can't,
Yeah,
sue you or
NDA
anything?
release form, firstborn child.
All right, that sounds good. Looking forward to what you guys are going to be talking about.
Yeah, pretty excited. I'm gonna just introduce Eric. Eric, him and I started talking, I think in August was when I started exploring Helios. But Eric, he's my go-to investment guru at Helios. He's a chartered financial analyst. That's a very nice way of saying he's super smart with numbers. He is my Swiss Army knife of asset management, bringing deep expertise across a variety of investments. He keeps his pulse on ever-changing markets so I can spend more time with clients. He crunches all the numbers and just makes all the magic happen. So, but his real thing is it's not just the basics, but he also understands how it all plays together, how I like my portfolio to work for my clients and all of it. And he's just pretty much an amazing guy. So he lives in Colorado with his wife, their cat Jackson. He likes to snowboard, watch the Iowa Hawkeyes, maybe not your best year, but active member of the CFA Society, and most importantly, a bourbon drinker like myself. Eric, welcome.
Hey, thanks, Nick. Happy to be here.
You have helped me un-F my portfolios. I'd like to think they're not all train wrecks, but as with the motto of this podcast, un-F your finances, just want to talk a little bit, maybe some of the biggest portfolio. You get to see tons of portfolios every day, every week from people, clients, advisors, the whole nine yards. Maybe just talk about some of the ones that jump out in your mind, those biggest train wrecks.
Oh man, that's a loaded question, Nick. Gosh, there's so many examples. I mean, like you said, I see a ton of portfolios come across the board. I mean, a guy came in, had just, did a little review of a client, and he had like a third of his portfolio in zero coupon bonds and bought them all at low interest rates. So this client's just locked in, making no money for a really long time.
Isn't that what got SVP Bank in trouble?
Yeah. They basically just bought those SPV bonds, right?
Perfect. What could possibly go wrong?
Yeah, it's funny. A lot of people come in, they're all the same fund family, right, wrong, and different, but you kind of feel like you're loaded in if you have just one company running your entire, asset management arm, right?
Yeah, and that's hey, I'm outside of Charlotte. It's big thing here. I don't want to look like a NASCAR driver that I have like King's Hawaiian Rolls and this and that, or Fidelity BlackRock. Like you can tell who's sponsoring me. Like my job as a true fiduciary is trying to take care of your clients as best you can. And how I came across you guys in Helios is that you talk to some of those fund families. So you see that, hey, if we partner and do your portfolio, you get everything. And the analogy, you guys heard me before say it, you go to a restaurant, they got 30, 40 things on the menu. They do 3, 4, 5 things really well, and the rest are just kind of there. So they get the chicken tenders for the kids. Are they really known for chicken tenders? So be it Fidelity, BlackRock, take your money manager. All of them do 3, 4, 5, 6 things really well, but you want to have it just stacked with that one company. And then are you a fiduciary, or did you just sell out for golf balls and a steak dinner?
You'd be shocked at how many times I'm like, hey, how many Pro V1s are you getting? Are you on the quarterly roll? Are you on the semi-annual roll? How often are you going in the water that you need these golf balls, right?
And then I don't know, a little tangent. Titleist sales went down when they bumped Pro V1s from $50 to 55 because like the per gift package is $50 limit.
Oh shoot.
So like a lot of them can only give a sleeve now because a dozen is over the gift limit. It's now a little bit too much. And if you're a bad golfer, you need every golf ball you can get.
I know you might want to step down to Strixon or something. No offense to Strixon.
Nothing but top flights going forward.
Yeah. No, it's funny. I spend a ton of time. You mentioned this, like the steakhouse or the restaurant menu. I mean, I spend a ton of time. I'm fun company agnostic. I think most fun companies do something really well. No fun companies do everything great. Right. And so I spend a ton of time just like looking at fun companies and figuring out who's the best at X and who's the best at Y. And they typically don't overlap.
Yeah. And the nice thing, so I hired them. Eric, talk to me a little bit about the overall Helios process. Like I go in there, I have my pick list, but if I get a fund, or for instance, I had somebody stop by my office yesterday, pitched all these funds, and I'm like, yeah, I'll look at them. I go in there and we get scores from 1 to 100. Makes it really easy. It gives you the X-ray, like cost, all the other stuff. Where does it actually fill into? Like, talk to me about how you guys get to that number, because that score is easy for me. Talk to me like I'm a puppy. Oh, this one's 92.
Right.
Once again, we got restaurants rating on cleanliness. You don't want to eat at a place below an 85. Do you want your money in a fund below an 85? Like, you don't want that 62 being in where you eat or where your money is.
Right. Absolutely. No, great question. So we've got the quantitative method, we've got an overall score, but really what goes into it, right? There's kind of two factors. There's the performance of the fund, which everyone kind of looks at, and that's the flashy lights, that's the neon sign that gets you in the door. Maybe it's not a neon sign, maybe it's a nice banner or something on the side of the road, but it's the performance. It's how did the fund perform, in up markets and down markets. What's the cost like, right? And for each asset class, it's different. You can't compare a bond fund to, a large growth fund on the same scale. So you have to compare it against their benchmark. You have to compare it against their peer group. So really, using data numbers to look at the performance, but also the other side of things is how did they get there, right? You could have a small cap fund that owned NVIDIA for the last 3 years, and well, that performance is probably best of category, but that's not style box true, right? NVIDIA, if you've heard of it, is not a small cap company. It's the largest company
You don't say.
in the world, right?
You learn something new every day.
And they keep, every day is just markets are hitting all-time highs, and NVIDIA is definitely part of that. And so not only do we look at the performance of the fund, but we look at how they got there. Were they doing some really exotic derivative strategy that's unrepeatable?
It's like saying my betting account's up because I hit a 20 leg parlay that paid 20 grand on a dollar bet. Like, we can't count on that versus how much risk do they take it?
Exactly right.
And then what's that index? What's that ratio? People talk about Sharp, Beta, Alpha. What is it? Patina, the one that Restino, the one that basically says, hey, how many deviations? Like, hey, it averages X, but what does it really do in a down market? Because most people I work the hardest when the markets are down. Year like this, markets are up, nobody's complaining, counts look perfect. But when the proverbial shit hits the fan, that's where people get worried. That's where people want to jump out of the portfolio, jump off their plan. And that's really where some of these funds can get a little dicey.
Right, exactly. I mean, and part of the methodologies are really looking at that downside capture and that upside capture. And it's not, it's not one-to-one from every asset class. And a lot of people shy away from, I'm a fixed income background guy, so I'll talk about what I know best. And people shy away from active managers and fixed income, but really there's two levers you can pull. Are you up or down in duration? Are you up and down in credit quality? And the ag is about 12,000, 13,000 different securities. That thing's the Titanic, right? It's just at the whim of what rates are and who's issuing, right?
Back up for a second. The ag is kind of like the S&P 500. It's kind of like ag is the aggregate bond index. It's kind of when people talk about Dow or S&P or NASDAQ, the ag is kind of that bond benchmark. But to your point, it is this massive entity, this blob, if you will. It's a Stay Puft Marshmallow Man coming down the road of bonds.
Yeah, exactly. And it's beatable, right? Like, there's no NVIDIA that you're missing out on in the bond market. All you're trying to do is get paid back, right? And if you can take on a little bit more risk and that bond pays you back, well, you won. If you take on less risk and that bond pays you back, well, you still won, right? You didn't default. And so that's really what you're looking for on the bond side of things. And I think as clients age, knowing your bond portfolio, knowing your manager, and I know we've talked a lot about this, is, of the funds that you look at and use, their drawdown is a lot less. So if you go through a 2022 kind of situation and everything's hitting the fan, like you mentioned, well, what if your manager pulled the duration way down? So they were way less interest rate sensitive, lot less price sensitivity in your portfolio. And you were down, instead of the ag being down 13%, you were down 6%, right? And then you go back on and we see the 2023 markets rip back, you're golden. You're starting at a higher base, right?
And explaining duration to the average person is always tricky. And I'm like, but think about it. If you have 30 years of payments, like your mortgage, it's a lot more sensitive reinvestment. Like you get that interest payment each month. Like, all right, well, what are you reinvesting it into? Versus something that's coming due in a year or less. Like, do you really care that the market's moved a little bit? Like I've heard the diving board, but like most people look at me, they're like eyes glossed over. At the end of the day, like I want my fixed income to be fixed income. Like it's not sexy. You want to get some interest and you want to get paid back. Like I think you hit something great right there is, we're not buying bonds to get some big appreciation. I know there's some pricing anomalies right now just because the last couple of years and interest rates going up and now starting to trend back down. But you're not buying that to, we got 10% return plus a 5% coupon. That's not what we're looking for. We want to get paid back. We don't want to have a default. And we want as much interest as we can get. We want that Goldilocks. You want the highest interest rate at the safest rate. And you got to find that just right. And talking about, we had someone who's, this bond fund pays 13%. I'm like, all right, that's like complete junk. That's a scratch ticket if that's going to make it.
Right. And it's like, we're getting in the weeds and like eyes are glazing over, I'm sure, but it's like, man, you just want in the quote unquote safe part of your portfolio, you want it to act safe. Right? You don't want it to be down 13% and your equity portfolio to be down 30% too. Right?
Yeah.
We talked about, kind of the scoring methodologies, but it's really like there's a lot of a quant that goes into it, but really just looking at the managers, seeing what they're doing, what are they good at, right? We talked about the restaurants again, and some are way better at buying high yield than buying just regular investment grade paper.
But you look at every single fund or ETF and truly know how that hot dog is made. You see what's in it, how they're trading it. Like, did they use leverage? Are they getting extra risky? Everyone, we're up so much, but how'd you get that much more than everyone else? All right, well, you were levered up. If we see a drawdown, well, this is what happens. A lot of times you don't realize who's swimming naked until the tide goes out, right? The Buffett quote and a couple of years ago, we saw the tide go out. And what did you really own here? And you can dicey pretty quick.
I think the big thing in bonds is the risk reward equilibrium's never broken. If you're getting 13%, well, you're taking risk in your portfolio. And if your advisor says that there's no risk in that portfolio, well, then they either are lying to you or they don't know what they're talking about, right?
Or the deadly combo, a little bit of both. Yeah. They don't know what they have and they don't know the truth. Like they're that old school advisor. Like they're the car salesman. Like we're going to tell you how fast it goes, the sizzle. They don't know what's sizzling, but they're going to sell that sizzle.
Yeah, this thing goes 0 to 60 in 1.2 seconds, but you're driving on a 25-mile-an-hour road.
Exactly. But so how about another one that I see, and I love the fact I can send you guys a portfolio. You help me rip through it of like, hey, this is what they're doing. This is what's working, what isn't working. So I take on a new client, like, hey, did you understand what you have here? And sometimes you look at this like, you want your portfolio to be working together. You want to be rowing in the same direction. And a lot of times it's like, I find, hey, we get these random REIT, we got this random bond fund, we bought this stock, and it's just like, literally like going through the aisle at like TJ Maxx and clearance. And you're like, what the heck is here? Like, this doesn't make sense on what's going on. Or another one I really see, like, let's talk about this one because it comes up a lot. People have, more often than not, people have a lot of money in their 401k. You're at a company for a while, you've been putting money along. How about those people that have 4 different target date funds and they're saying they're diversified, whereas it's Coke, Diet Coke, Cherry Coke, and how about Crystal Coke? And if you're old enough to remember Crystal Coke in the 90s, we probably need to update your plan. But help me go through that one.
Yeah, I mean, there's a lot of flashy ideas out there, and I think, you know, once the most of the community's on it, and if you know your client comes in and they're saying, hey, it's time to talk about private credit, well, okay, everyone knows about private credit now. It's too late. You're not getting the private credit returns of the past. You're getting the private credit returns for the next 10 years forward.
And how about the fact that private credit or these hedge funds that are coming out there, oh, our minimum is only 100 grand. Why do you think they're coming to you? The people that have 10 million, 50 million to buy into this have passed, and now they're coming down. You're getting the leftovers by the time it comes down to your typical retail investor that, oh, you need 100 grand to invest in that. More people can do it. Do you think those people really want to deal with a million people at 10 grand a piece versus 10 people at 10 million a piece? Like, it's just, I get so skeptical on what's getting pushed down the river on that stuff. But
yeah, you have to think that, you know, when you're getting lower minimums, you're getting not the best ideas ever. There's great ideas probably in that portfolio, but there's a mixed bag of a less than ideal, you know, funds or investment opportunities that might have gotten rolled into this XYZ idea.
how about that though? On the 401k front, most people know they have limited funds. What are some of the like oh my God moments of like you've seen some things in there? Help me out on that one.
You know, like someone's, like you said, the target date funds thing, but maybe it's just in cash, right? You've been working for this company for a very long time. You decided to not look at your 401k at all. So it's been in cash this whole time in a 0 interest rate environment for the last whatever, how many
The
years.
company stable fund.
Yeah.
You're like, oh, I'll set that up eventually. And they just leave it there.
Yeah. And now you've missed out on 10 plus years of 7% returns in lieu of safety, right? And I think the tough thing for a lot of individual investors and why the advisor role is so important is get someone in there looking at it for you that knows what they're looking at and can kind of evaluate the different fund options. So you're not just saying, well, yeah, like international seems good. I went to Italy a couple of years ago and I really like the pasta and I should invest in an international fund, right? Is that the right time? Is that the right thing? No, you got to go to an expert, I think, and
yeah,
and see what they have to say, right? Otherwise, you're just kind of throwing darts at the dartboard.
Yeah, and that gets tricky. And look, I'm an advisor. I love building portfolios, but the amount of math and all the other number crunching, like it's too much. And you guys have, that's why I hired you guys. You're able to cut through the noise and everything else and drill down. And we have the score sheet. But another one that has come up a couple of times. Hey, like there's a certain Bitcoin is suddenly like the hot thing. And it's like, everyone's like, oh, why don't we have this? And I'm like, because you would have sold out of this 2 years ago. You wouldn't handle. But it's one of those things everyone's talking about. It's the end of the year. You're coming into it and people are going to go look at the screen or of what was best last year. Like, do you see that a lot? Or is it just, I have like just a lot of pain in the asses calling about looking in the rearview mirror?
And I got to go back to like, look, what's the process that we're trying to do? Are we trying to hot dot chase and go into Bitcoin after it's up? I don't know how much it's up this year, a couple 100%. And then you ride a 60% drawdown and now you're mad at your advisor or whatever for hot dot chasing? Or are we going to stick with a process that's repeatable over the long haul where you feel like you're comfortably and methodically growing the account without just throwing lottery tickets?
Yeah, I'll grab a Powerball ticket. Heck, I grab scratch offs now. My in-laws do that on Thanksgiving and Christmas. So that's now one of the things. Throw a scratch off. That's fun. That's a little bit of gambling. Maybe we get lucky. But this is your life savings. You've worked your ass off for this. Do you really want to go scratch ticket or 15-team parlay with your retirement? Are you okay taking that much risk that you might have to work 5 more years?
Right, exactly.
And I know it's sexy, but like, my philosophy, my just I don't know, credo, I don't know, investment policy statement, whatever you want to call it. But like a pillar is like, you got to slow and steady is going to win that race. I'm not going to gamble with your life savings. Like, it's just not acceptable. Like, even if I was right, it's still not like, just because you got away with it doesn't mean it's right.
Yeah, you hit a 20 team parlay one time. Your chances of doing that two times are pretty low, right? So stick with the methodical process, just bet the spread.
Yeah, no, I hit a TD parlay. It was $30 to win 1,800. And now I'm like, every weekend, I'm like, oh, it's going to happen again. And we've been doing the, my Bo parlay. I let him pick every game. And twice he's come one game away. And he's all upset. I'm like, I'll do like $2, let every game. It's like, it was like 2 to win $6,000. And he's like, can I get a PlayStation? I'm like, yes, if you hit this, you can have a PlayStation. Like,
right.
But like, is that how you want to get to retirement?
Yeah. And like, speaking of that example, right? He did it, what, 14 times right out of 15 or whatever it was. And, you get down to that last one, you've grown your account very methodically for 30 years and you decide to chase Bitcoin right now. And you erase year off of your gains, right? Same kind of situation. You got it right mostly.
Yes.
But that one just shot yourself in the foot going too hard.
And that kind of flips into the risk tolerance. Did a year-end review with somebody that is very risk off with me. Hey, the account moves 5%. Hey, what are we doing? Well, like, they get a little rattled and they happen to be bragging about this smaller account they have. And I'm like, well, what's in there? He's like, well, it's up. I'm like, if you're more of a 50-50 with me and we pull back the covers on that one and it's 90%, like, how often, like, do people just forget what risk tolerance is? Like, or is that just such a mythical word?
It's pretty much a mythical word. In up years, it doesn't matter what your risk tolerance is, but in down years, you better have protected me, right? It's what have you done for me lately? A little bit.
Yeah. I want the same up as the S&P and no down. Isn't that like the
I mean, I do too. That's what I'm looking for every day, but it's impossible, right? It's chasing that parlay.
Yeah, but no, it's always just a little bit crazy on that part of like, and I'm like, I'm managing $2 million for you. We're up several $100,000 this year. It's a good year.
Mm-hmm.
And you're going to go hold out. Hey, I have this $50,000 account that's up X. I'm like, are you going to call yourself and be like, hey, I shouldn't have been this aggressive?
Right.
Like, to your point, up markets, why aren't we up more? Like, up takes care of itself. Like, we've talked when we build out my portfolios, more worried about downside. So if I can keep you invested, good things will happen. Up will take care of itself. And that's the other nice thing with you guys at Helios is like, we're getting those, I get every 2 weeks, getting the emails, the weekly calls. And it was nice to also add in those portfolios that like, hey, if with all your factors or elements, however you want to phrase it, if green lights are on, we'll go up 10%. And if we see start yellow and reds, a couple of them, we can go down as much as 30% of taking that risk off. Like, that's been a nice evolution of, hey, I try to rebalance, stay the course. But there are some people, you get into retirement, you can't have that drawdown.
Right. You're looking for that income and you need that income, and a big drawdown in your portfolio. Well, guess what? Now you're pinching pennies. The ramen is flying off the shelf.
Heck, I even think ramen's more expensive. Like, I just think about like growing up, how many times you heard about a $5 footlong, and now it's like, oh, in the app it could be $7. I'm like, you spent years of marketing on $5. Like, I almost think you need to keep one. Like how what is Costco does with the hot dog?
Oh yeah.
Like, it's going to be $1.50. It's going to be a loss leader, but you can't break that. Like, Arizona iced tea, still 99 cents.
I want that $5 footlong,
Yeah, bring it back. Like, I don't want to eat it. We had one on campus in college, so I had way too much, and like now I can't like skin crawl seeing it. But like, those are some of those things. Dollar menu, $5. Like, but that's why we have that new. Like, so I still have that static. You guys help me with that. Hey, we're going to rebalance 3 or 4 times a year. We have those other ones that can go up or down 10 or up 10, down 30. And that way there, it just gives me one more tool in my toolbox to try to keep those people invested and protect that nest egg so throughout retirement, they're not running out of money.
The nice thing I think about, for you and your practice is like, you could have just stayed the course, right? You could have just been doing what you're doing, head down, 30 years, whatever. Or is there ways to do things better for your client, right? how can you make sure that they do meet those long-term goals? And it's a partnership, right? I work for you just as much as I work for Helios, right? Like, I care about what happens to your practice, and making sure that you are getting success with your clients, right? Like, at the end of the day, it's a partnership. It's not Helios and St. George Wealth Management. It's a partnership.
No, it definitely is. And that's been just, there are ways to build a better mousetrap. You guys have the technology, there's all that quantitative research. It's not what it used to be. Even when I got into this business, or hey, my very first time playing a stock market game when I was 10 years old, like the data, like there is an evolution, and you got to be learning and getting better of it. And no, I appreciate you taking the time. I know you got a lot of stuff. And as my first guest on the podcast, we're going to start something new here. We're closing favorite bourbon. You're a bourbon drinker. We've talked about this a good bit. What's your go-to bourbon? And if it's your birthday, you're celebrating, what's on the wish list?
Great question. So people are over, we're hanging out, something that's accessible, drinkable. You got to go with the Weller 107, the antique, right? The red bottle per se.
Yeah.
Love this one. Everyone likes it.
It's actually my favorite Wellers. I have the whole lineup, and I actually enjoy that one more than the rest. Foolproof is pretty good too.
The 12 is also fantastic, right? But then if I'm going, I've got some more sophisticated bourbon drinkers over. They want a little bit more heat. I've got the Jack Daniel's 2020 limited release single barrel rye.
Ooh.
These were just excellent limited time production. You say it's Jack, but honestly it's great. I'm going to send you a little sample of it. You'll enjoy it. It'll put a little hair on your chest, Nick.
Yeah, this takes like 6 weeks. I'm so close to puberty and a growth spurt. Someday I'm going to get there. So I'm going to tell the story of the tainted bottle. A year ago, I moved to LPL. My gift to myself was the 20-year Pappy Van Winkle. And I said I wouldn't open it right away. I would wait for some goals. And it's been good. You guys have helped. The market's helped. Referrals from clients, this podcast. So I'm like, let's open it. It's time. I'm going to pour it out. And yes, I might have already had a couple in me, but I hit my goal. It was whenever. So I twist, and the cork explodes into it. Had to get cheesecloth, filter it out into a decanter. But this is my unicorn. The only other unicorn I'm really trying to get is Birthday Old Forester. But my everyday go-to is Toasted Barrel Elijah Craig. Never go wrong with that. Are kind of the two we'll talk for today. I'll break out some more in the small collection here next time. But Eric, it means a lot that you took the time. I know you're busy. Love the partnership. Love having the confidence that like I have all the data all at my fingertips, and I can always call you too. Hey, what the heck is this? And you're there for it. So I really appreciate you coming on here, talking about some of those disasters and just the process.
Yeah, absolutely. I'm happy to be here. Hope to be back sometime in the near future if the feedback is well received. But Nick, again, thank you. Great time. Great chatting.
Appreciate it.
All right. Before you two go, how about some contact information? We'll start with Eric, you first.
I work Helios Quantitative. Heliosdriven.com is the website. You can kind of find all the information on there. Tell them Eric sent you. I don't know. That's what people say, right?
Okay. Sounds good. And Nick, your turn. Contact information.
All right. Office number 828-481-8836. Nick at stgeorgewealth.com. You can find me on LinkedIn, Facebook. And that's about it right now for the socials. I'm too old for the other new ones. And but I'm pretty easy to find. Daughter loved that I closed one of the last ones with the ROWDY. But I'm pretty easy to find. Google me, Facebook. But any questions on this or want to dive deeper into Helios stuff, let me know. Happy to explain how the portfolio, how that hot dog is made.
All right. That sounds great. Looking forward to your next podcast. And thank you for listening to today's Unf Your Finances podcast. Please like, follow, and share this podcast with friends and family. Until the next Unf Your Finances podcast, I'm RJ Malik.
Thank you for listening to the Unf Your Finances podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.stgeorgewealth.com or give us a call at 828-481-8836. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of St. George Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA and SIPC.
Any guests in their company or companies are not affiliated or endorsed by LPL Financial unless otherwise stated. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.